Hey guys, so today we'll be looking at how to identify bubbles by using a 300-day exponential moving average. So the packages we will require is quantmod, and to kind of illustrate, we'll use the S&P 500 ETF. So we'll plot a chart, use get symbols. I wanted to use a really long exponential moving average because it kind of solidifies the trend. And as you can see, the stock may move away from its moving average, but eventually it returns or crosses it. And I really wanted to find out how far it moved away before it eventually returns. Let's try to zoom in a little bit. So here we kind of see it move away from the exponential moving average, and due to what's going on, it kind of crashed and crossed it. So in this video, we're going to find the percentage change between the stock and the moving average, and then we're going to summarize that data and separate them into quantiles. And then we're going to make some trading decisions and then see how profitable that turns out to be. So I'm going to build a function called get300. And what this function will do is get the data, extract the adjusted column, merge it with its 300-day moving average, and then find the percentage difference between the adjusted price and the moving average, and then it's going to return that to us. So all we need to pass in is the ticker. So here we'll get the data. And then I'll calculate the 300-day moving average. So the period will be 300. Then I'll combine the adjusted prices with the moving average. And then I'll calculate the percentage difference here. And I'll round that to 4 decimal places. And then since it's going to take 300 data points, I only want to extract complete cases so we don't have a bunch of NAs in our data. So I'll just use complete cases. And then finally just return that data. So I'll run that function and store it into temp. So our data actually starts in 1994, and we see the adjusted price, the EMA, and then the percentage difference. All right, so let's display a brief summary of the percentage changes. Interesting, so the stock was actually 39% below the 300 EMA at one point in time, and then its max was close to 25% above its 300 EMA. Alright guys, so now we're going to build a function, and what this function will summarize is a trading strategy, and the trading strategy is it's going to separate these percentage returns away from the EMA. If it's trading too high, I'll short it, and if it's trading too low, I'll buy it, and then I'll close the position when it crosses the EMA. Alright, so now we're going to build a function, and that function will summarize a trading strategy. The trading strategy is we're going to short when the percentage difference between the stock and the EMA is too high, and then we're going to buy when the percentage difference is too low, and then we're going to close the positions whenever it crosses the EMA. So here we'll put our function name, which is summary. And then for our parameters, we're going to pass in temp, our buy point, our short point, our starting equity, and then I'm going to add this called per side fee, which is supposed to be for commissions, but we can also use it for slippage. And then from will be a date we want to start this from. We're going to be running this as we go, so I'll insert some parameters. So for equity, I'm going to start us off at $2,500 per side fee. I'll just use $1 since it's per side. And then for the date, I'll start us at year 2015. For buying point, I'll place that as 5%. I'll explain what that means right now after we calculate the quantiles. And then short at 95%. Alright, so since we're starting from 2015, I'm going to subset our data. To do that, I'll just write temp, paste 0, put in from here. So now it starts at 2015. Alright, so now we're going to calculate the quantiles for the percentage difference between the stock price and the EMA. So we use quantile, we use temp percentage, and then for the probabilities, we'll put sequence from 0 to 1, separate that by 1%. So if you take a look at our quantiles, so essentially I want to buy at 5%, which means whenever the percentage difference is or equal to this percentage, and then when it's at the 95% mark, I'm going to short it. Alright, so now I'm going to add a signal, and this will keep track of when we enter and when we exit our positions. So I'll add a -1, which will mean we want to short. A +1 means we want to long or buy the asset. And then 0 will mean we're flat. But now we're just going to fill them with NAs. Alright, so this is going to be for our buy signal. So whenever the percentage difference is less than or equal to or quantile threshold, I'm going to buy. So I'll add a 1. Alright, this will be for our sell signal. So whenever our percentage difference is greater than or equal to our quantile threshold, I'm going to replace that with a -1. Alright, so for our flat signal, we're going to put a 0 whenever the stock crosses the exponential moving average. So that's going to be represented with this. Alright, so now I'm going to run these lines. So here we have a cross. It went from positive to negative. So that's represented by 0. This crossed our lower threshold, so it's 1 for buy. Couldn't find any short signals. So now I want to get rid of these NAs, and what I'll do is I'll carry forward the last observation, and that'll replace these NAs until another signal is thrown. And that's done using NALOCF, which means last observation carried forward. So let's look at our object. Great. So whenever a signal is thrown, we'll be long until the signal changes. So now I'm gonna have to lag the signal so we don't trade that same bar. So just in case, I'll add zeros for the first observation and the last observation. So for the first position, we'll add 0. And for the last observation, we'll add 0. We'll run these. Now I'm going to have to fill in these NAs, so I'll just use this again. There shouldn't be any NAs for signal. Great. Alright guys, so now I'm going to start adding columns to keep track of our trades. So the first column I'll add will be stock, which is our stock price for that day. But I'm going to round that to 2 decimal places. So this is our stock column now, and we're going to use it to make calculations later. Alright, so I'm going to add a column that's going to keep track of our entry and exit prices. We'll set that column equal to NA for now. And then the very first observation will be our very first observation for stock. Set that equal to a numeric. Alright, so now I'm going to iterate through each row. If the signal changes, so will our price. So essentially, if this were a 1, it would change our trade price to this current price. Alright, so I'll do for II and 2 through the number of rows and temp. Do the following. Alright, so I'll use an if else. So here I'm going to compare the signals. So if the current signal is the same as the lag signal, I'm just going to bring this last price and carry it forward. If not, then I'll use the current price. So it'll change whenever the signal changes. We'll use core data, temp, sig. It's the same as core data, temp, II minus 1, sig, data. We use temp, Alright, so it's going to iterate through each row and do the calculations. So here I'll run this. We'll take a look at temp. So we'll see whenever it changes. So here the signal changed, so it returned the current price for that stock on that day. And it's going to do that every time the signal changes. So here the signal changed again, it returned the latest price. Alright, good. Alright, so now I'm going to add a column to keep track of the number of shares we can buy. And then I'm going to round that down, so I'll use floor. So equity divided by temp asset 1. Take a look at temp. So with equity of 2,500 at whatever this price is, in this case we could afford to buy 13 shares. And it's going to keep track of how many shares we can buy whenever we get a new signal. Alright, so now we're going to calculate the number of points that signal generated. So we'll use temp points. We'll do an A. So again, we're going to have to iterate through each row. So we'll do for II2 to the number of rows and temp to the following. We'll do temp II points. We'll use an if else again. We'll copy this. So we're going to calculate points whenever the signal changes. So if the signal is the same, I generated 0 points. Otherwise, we're going to do round. We're going to use core data, temp, our iterator, asset 1, minus core data, temp, our iterator minus 1, asset 1. So the current price minus the previous price, and then we're going to have to multiply that by the previous signal. So we'll do multiplied by core data, temp. This is our lag signal. Alright, so we're going to calculate the difference between the current asset price minus the previous asset price. Multiply that by our lag signal, and then we're going to round that to 2 decimal places. Alright, so let's iterate through that. Take a look at our temp. Alright, so here we got a buy signal on this date, so we entered at 170.29, and then we closed it off on this date. So the difference between these two should equal 1133. So we'll subtract 181, 62, minus 170, 29, and we get 1133. Alright, good. I'm going to replace this with 0. So we use temp points. The first observation, change it to 0. Great. Clear this out. Now we're going to calculate our gross profit. Set that equal to NA. So again, we're going to have to iterate through each row. And we'll do the temp, iterator, gross. We'll use an if-else again. So if the core data, temp, iterator, points, does not equal 0, I'm going to round core data, temp, iterator, points. I'm going to multiply that by our number of shares. So we'll do core data, temp, iterator, shares. Going to round that to 2 decimal places. Otherwise, we turn to 0. Alright, so we'll run this. Take a look at our temp. I'm going to set this equal to 0. So here it's saying that our gross profit is 147.29, but let's double check. So we were long 14 shares. We made 11.33 points. So 1133 times 14 is 158. So we didn't lag the number of shares. So I'll do that here. Set that equal to NA again. Run this. Change the first observation for gross. So now it's equal to 158.62. Close that out. Now we're going to calculate our net profit. Set that column equal to NA. Again, we're going to have to iterate to the number of rows in temp, iterator, net. We'll do if else. So if our current iterator of gross does not equal 0, I'm going to round core data, temp, iterator, gross, minus per side fee. Multiply that times 2. I'm going to round that to 2 decimal places. Otherwise, we turn to 0. So we'll run this. And then again, change the first observation of net to 0. Alright, so our per side fee was $1. So essentially take away $2 from our gross to get our net. So that works out good. The next thing I want to calculate is our equity curve. So we'll set that equal to NA. Make that first observation our current equity, which is equity 2,500. And then we're going to iterate. All right, so temp, iterator equity, if else. So if core data, temp, current iterator, net is not equal to 0. I'm going to round core data, temp, iterator, net plus core data, temp, iterator minus 1, equity, and round that to 2. Otherwise, return core data, temp, iterator minus 1, equity. Alright, so if our net does not equal 0, I'm going to add our net gain or loss to our equity, and that should keep a running total throughout. Alright, so we'll run this. Take a look at our temp. So we started off with 2,500. So here we added 156.62 to 2,500, and we got 26.56.62, which sounds right. And then finally, I just want to return temp. So we'll take a look at tail of temp. All right, so for this trading strategy, out of $2,500, our ending equity was $26.85.69. So we'll take a look at a plot. So here we saw some gains. Looks like we lost some money and now it's getting back up. Alright, so now I want to get rid of everything. I'm going to rerun this. So now we'll run this function. So temp equals temp buy at, set that equal to 5%, short at 95%. Our equity will be 2,500 to start. First side fee will be $1, and then we want to start that at 2015. We'll take a look at our tail, the ball, and we get the same results. Great. So we could adjust the parameters. We'll set this equal to 3%. And this top range, 97%. Get the tail of the ball. So here we have more gains. So we'll take a look at our equity curve. So this is a better looking equity curve. I want to see P&L for each trade. So I'll subset all net greater than 0. That does not equal 0, sorry. So we have a couple trades, not many. 2, 3, 4, 5, 6 trades. Our worst was negative $57. So it seems that if we use a wider bracket on quantiles, it does a little bit better. And here we see a trade almost every year. So this is kind of what we want and what we're looking for. We don't want it to trade often, but when it does, we want it to be right. So now let's do another asset, a different asset. So we'll delete everything. I'm curious to see what Tesla did. So this is the 300 EMA, and it's currently trading all the way over here. Which is very interesting. We'll plot the equity curve. So again, we see a nice steady uptrend in the equity curve, but I have a feeling it's not doing so well right now. So we'll plot the last 50 observations. Okay, so I believe I set the last observation to 0. Yeah, so we'll clear that out because it's currently saying that we're short, but we're short since its stock price was at 746 and currently it's trading at 935. So if we were to exit out that position, it would have lost 568.76, and we're trading only 3 shares. So we'll take a look at our P&Ls. All right, so our P&L is a little bit higher, but currently, since it's trading so high, who knows how long it'll be until it crosses the 300 EMA. But fairly interesting. All right, guys, so that's it for this video. Just wanted to show you guys this strategy and hope you enjoyed it. Leave your comments down below. You can ask me any questions. If you find anything interesting, let me know in the comments. And I'll see you guys in the next video.